Luke, good to have you with us this morning. We're focusing a lot on crude into negative territory. Simply put, what's it telling you?
Yeah, thanks again for having me on, Ben. I think you highlighted it well. I think it's the combination of the coronavirus shutdown. I think we're topping out storage levels. And then I think you factor in, you get a look at the degree of financialization in WTI contracts yesterday that exists by the fact that it was able to go as negative as it was. The bottom line is I just don't think the financialized contracts were set up for the world that we're now living in, which is, so much of GDP shut down as a result of COVID.
Luke, let's talk a little bit about, I kind of squeezed in the Kim Jong-un story. I'm curious, there seems to be some concern associated with this. I mean, basically, my understanding is it would lend itself to a little bit of a leadership gap or uncertainty, and that's adding to some of the uncertainty that we're already seeing related to the coronavirus and the unknowns related to economic conditions. How big of a deal is this one?
I think it could be a really big deal. I mean, you're talking about a nuclear power. You don't like hearing, power vacuums in nuclear powers, particularly one that has had such an adversarial relationship with the world, with the United States in recent years. I would have to believe that Chinese authorities are probably a little uncomfortable with this situation as well. And
Yeah, yeah.
that's certainly that adds to just a generalized sense of discomfort, I think, around the world at a time when we've got more than enough discomfort, unfortunately, already. So it is, watching closely. We'll see the stories that come out of it, but I do think it has a potential, like you said, to be an important story.
Luke, that's, I guess, what concerns me most of all, a system that's already taxed. I mean, this is not necessarily what we need, combined with crude oil prices and the uncertainty that creates to the downside. Luke, I wanted to just point out that some of the numbers that we saw in terms of employment numbers out of the UK were actually a little bit better than expected. The looks like Germany's ZEW numbers came in a little bit mixed. Can you talk to us about what you've got your eye on? Because I'm curious, is it crude? Is it the jobless numbers? Is it the indices that are starting to roll over again, it seems like, and potential for a retest of those March lows that we saw? There's a lot going on, and sometimes it's difficult to figure out where exactly our focus should be. It's tough to consider everything at this point, but again, there is a basket of influences right now and catalysts that we're faced with.
Yeah, I think looking at it from a basket perspective in terms of catalysts is the right way to look at it. Over the last few weeks, one of the things we've been paying most attention to has been the Fed's balance sheet and the efforts that were put in place to basically tighten spreads, broadly speaking. And that has worked, and that has brought us time. But now I think it's important to consider that that basket perspective that you're looking at, because I think while the Fed has sort of fired their first gun, if you will, we're now getting into reality. And I think what the oil move yesterday showed was maybe sort of the first big reintroduction of reality, which is to say, the Fed can tighten spreads, they can drive liquidity, but they can't create crude storage. They can't create crude demand.
Yeah.
And if that's why I think we may be getting into another leg of this potentially, where reality of what's happening in the physical world starts to dominate once again relative to the central bank balance sheets that have dominated the physical world over the last several weeks. And so for me, what I'm watching are signs of either reopening or extensions of shutdowns. Because right now you're whether it's crude, whether it's small businesses that are coming out and saying, look, we don't have that many more weeks of reserves, and then we don't know when or if we'll be able to reopen. These are the things that the central banks simply can't help. And so I think we're getting into a very critical time where, and it pains me to say it, but I don't know that crude will be the last thing we see go to zero if we continue to be an economy where you've got the markets open, you've got stores closed and borders closed, because it's simply as highly financialized, as highly leveraged as we are, with the economy shut down the way it is, it's just a formula that doesn't work.
Yeah, Luke, I think it was the IEA last week kind of echoing what you were talking about, or what you're echoing their comments, I guess, in some ways, in terms of they mentioned basically no cuts that OPEC could bring about could counterweight some of the demand destruction that we're seeing right now. Let's talk about to zero, though, as you just mentioned. I'm wondering how closely focused on you are rates right now in terms of the move. We saw the 2-year into a new record low, the 5-year into a new low. I mean, ultimately, this is what will force the Fed's hand. They're reluctant to go to zero. They've said in the past, this administration is as well. But, I mean, ultimately, market has its last say, doesn't it?
I think that's right. And there's been this, over the last several years, this discussion of a risk-free asset shortage effectively out there, a collateral shortage. And if you get another downturn, which looks like could very well be the case based on what we saw out of Crude yesterday in terms of the data and importantly in terms of the financial markets, because I think it remains controversial or poorly understood that the financial markets are really leading indicators of economic demand based on how, in particular, the United States has structured its economy. They are critical to driving consumption demand. They're critical to driving wages. They're critical to driving tax receipts. And so if you get a retest of the lows, you're likely to get renewed downward pressure on GDP growth from whatever point we're at that point, assuming we haven't fully reopened then, which doesn't look like it's going to be the case. And so then you're going to be seeing this flock into into treasuries, and then we get to, okay, can we get to zero? Sure. Can we get to negative rates on treasuries? And that suddenly becomes quite possible, and then you get into trickier dynamics of can the primary reserve asset of the world have a negative rate on it? And who knows? In the short run, it can. In the long run, that's not a system that can work. To me, it all keeps pointing to the same thing, which is I don't own enough gold.
I hear you, Luke. The interesting thing is gold actually has been coming off. Let me just pull up that chart right now as you mention it, because it has been coming off. Do you think that this is just part of the trend that we've been seeing in gold in terms of the upward movement with a slight pullback? This week back down below 1,700, but again, it sounds to me like with everything playing out, gold in theory is the safe haven asset of preference.
I think that's right. I think it is just pulling back. You've seen real rates pick up a bit in the last week, and I think it's responding to that. It, of course, had a pretty big run over the last several weeks, as your chart shows. So, but ultimately, depending on how this plays out, you start getting into, gold's the only asset, or one of the few assets. I would say Bitcoin's probably another one, but gold, physical silver, but gold really the primary reserve asset where it's not somebody else's liability. And when you're talking about the types of disruption that we're talking about, where we can see oil go negative or move towards zero, you're talking about severe financial disruptions and credit concerns across the spectrum, unfortunately.